Awesome. So you guys seen straddles, seen short straddles. I mean, you guys are on a roll. You're on fire. Give yourselves a pat on the back, a comment, chat, whatever you like to do to show yourselves that you are crushing it. So we're getting to one that I know a lot of people, and they swear by this setup. It's called the Iron Condor, and I just can't for the life of me figure out why these guys love it so much. I know so many traders and they use it all the time. And what I noticed is that most of the people that are using this strategy are sort of like higher net worth individuals. And because of that, it's a little bit more difficult to get into 90 new trades when you have like I'm talking like hundreds of millions of dollars. And and so because of where they're at, like with 9 to noon trades, like basically you have like maybe 5, 10, 15, 30 million shares traded in a day on a $10 stock, which is like $300 million. And so if you want to create a $300 million position, it's kind of tough to do on a 9 to noon stock for most 9 to noon stocks. And so what this here is an iron condor, and you sell a put and you sell a call just like a straddle. And then you kind of limit your downside by buying a put and buying a call, just like a long straddle. So it's like a short straddle and a long straddle. You just kind of like mash them together. And this is and basically right. You make your profit right here in the middle when the stock doesn't move very much. So same thing we talked about earlier. If you don't think the stock's going to move very much, this is the strat. Now, the difference between this and the straddle, the short straddle, is obviously you're buying a put, you're buying a call. So it kind of limits your downside to this price level down here. Now, I want you guys to see the risk reward ratio on this trade, and this is why I'm super skeptical of it. Like, I never use this. This is your risk, and this is your reward. That's pretty bad. That's really, really, really bad. And you can make this trade 1,000 times and make this teeny little reward 1,000 times and turn out profitable and make some pretty nice returns. But you're gonna make like what, like 2 or 3 or 4% on this trade? Like this is not a very cash enticing trade. And it depends on the stock, obviously, and it depends on the volatility. But usually, you're not going to make a whole lot on this trade. It's just this little bit of upside and this huge, huge, huge risk. I mean, it's like pretty much the opposite of the risk reward setup that you want to see on any of your investments, right? Most of your investments, you want to kind of risk like this much and then have the potential to gain this much. And that's the goal for so much of what you do. And this setup, it just kind of reverses that. And it basically like this is your risk and this is your reward. And that's kind of like initially what would turn me off and what's continued to turn me off. Now, a way you can kind of increase the amount of money you can make is if you get rid of these puts and you get rid of this call and you don't buy them, you only sell. That'll obviously increase your upside, and at that point, you're basically just doing a straddle. And that's something that some people do if they just have straight balls and they know that it's going to stay in the same price point. But again, this is really what we just talked about earlier with the straddle. This is a short straddle. The only difference is for an iron condor, it's 4 trades, right? So you have the sell, the put, sell the call, and then you buy the call and you buy the put, and it limits your downside versus with the straddle, short straddle, you don't have a limited downside. And that's why when we were talking about it earlier, I was saying like basically it's kind of risky because you have an unlimited loss, and that's why you want to keep it usually in a shorter time frame with a more stable company and be more careful with the companies that you use this setup for. The Iron Condor is a little bit more versatile. You can use this sort of with any stock that you think is going to stay at the same price range because you do have this limited downside. But remember, you're buying calls and puts here, so it's going to decrease your overall profit margin since you're reinvesting cash into the actual trade. And these puts and calls are in the money, so it kind of actually makes you spend a little bit more money getting into the trade. So again, this is something that you can do if you think it's going to stay in the same price range, the same trading range. You can trade the Iron Condor. It's popular among some people. I don't really know why. It's a pretty bad setup. I've made a couple of things with it, and like you can make small profits, but I mean this is I just usually do my swing trades and 9 to noon trades, and naked calls, and those work really well when combined with technical analysis. This is more of a setup for somebody who just kind of wants to sit there and do nothing and just play off a stock like we talked about yesterday, where it just kind of, or we talked about in the last video, where it goes up and down and up and down and up and down. There's no real defined pattern. But that would be sort of where you would use this, and then you can limit your downside. It's great in theory, and a lot of people, I mean, it's cool, but I just don't find myself using it very much. But it's kind of cool to know that you can do this if it fits into a very, very specific stock. So maybe you have a stock that's always been in the same trading range for a long time, and maybe you want to do like a 1 year setup with an iron condor. This would be a better way to do it than using a 1 year straddle, because you could have a limited downside for that 1 year in case stuff goes south. But since you're doing it for a whole year, you have a lot more upside. So again, it's not going to be as much upside as doing like active management. You're looking usually 5% here. But it just depends on the stock. So if you're interested in something like this, you're thinking about it, check out what the pricing is for your stock, because sometimes you can get like 20% selling some of these calls and puts. And 20% when the stock doesn't even freaking move is really, 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 really good. So definitely look into selling calls and puts and doing straddles or iron condors with those longer term positions, because I mean I've seen really, really, really good returns, and you got to remember the stock isn't even freaking moving. So that's a pretty nice way to do it. And the iron condor is a way that if you do go into it, you can actually limit your downside and just cut a little bit off the top here. So it decreases your risk, decreases your reward. But then there's also like a lot of risk. But there's a lot of risk with the straddle setup, right? You gotta remember the straddle setup has like infinite downside. So this one, it's safer, and it has a lower reward because it's safer. So definitely a thing to consider. But remember, if you're actually holding the underlying stock, it's a lot safer for both of these setups. It's a lot safer if you hold the underlying stock, because it's not a naked sell, and so you kind of have like collateral for it. And like we talked about in the last episode, last module, since you are holding it for the long term, most likely for a trade like this where it's just going sideways, that would allow you to keep buying in at lower prices or selling out at higher prices. Which is the benefit of taking a trade like this, is that if it does go south, you're sort of just working it into your overarching long-term portfolio. And if it works, then you're just getting extra income from a stock that was just chilling out anyway, especially if it's paying dividends or any other kind of distribution. So really, really nice strategy. It complements the straddle, short straddle, and it's a good way to make it happen. If you think that stock is just going to sit there and do nothing, pretty expensive thing to set out, because you are doing 4 trades, and then 2 of those are buys, 1's are calls. So these are really, to generate cash, and then this is where you would spend that cash. And that's the point with it, is that you're giving yourself just a little profit margin right there, and you make the trade 50 times, and you can make a lot of money with it. It's just a lot of work for, well, it's not a lot of work. I mean, you could probably do this in like an hour a month. For a couple of stocks. I just kind of like trading 9 to noon, and that's sort of what I do. And it doesn't really fit into that as well, because I don't really follow companies that don't do anything, because that's kind of boring. So just a perspective on it, and it might fit your investing style, especially if you are nearing a savings or retirement goal. This is a really, really good way to stabilize your income, especially if you're moving into more bonds, bond funds, or just like general ETFs. This is a solid way to increase the return on those assets. I usually say like I'll never actively trade options on the SPY or the S&P, but you can use options to really increase those long-term returns on a month-by-month basis or year-by-year basis, using these option setups, using the iron condor to just get a little bit more out of your performance. Remember, we talked about this in the last module, this idea that if you can just get a little bit better, it's going to compound and compound and compound and compound. And what this does is it gives you the ability to get this little bit of extra cash with a lot less risk, since it's unlimited risk to just this risk. So you still got to be careful with it. You definitely want to be right so that you don't lose. But it's a nice little setup, and it works really well in long-term portfolios. So take it as it is, and balance it against your straddle, balance it against the time period that you're using for any kind of stock that you have, which just goes kind of in the same trading range and you want to profit from it. But also understand that these things can break out, so make sure that you are using those technical indicators and your skills with analysis of charts and fundamentals. So you can figure out exactly where the stock price is going to go and then implement the best option strategy for that movement. So really cool stuff, guys. Thank you so much for watching this module, and I will see you in the next one where we're going to talk about butterfly spreads. Woo! Thanks. Bye. Have fun.